There you go. Okay. Hello, everybody. Thanks for tuning in. We it well, I guess it's probably late for Happy New Year, but Happy New Year, I guess. So thanks a lot for tuning in to our sessions. We try to do these a couple times, from time to time. The first clarification I'll make is, well, a lot of you might think that Slidebean is some sort of nickname that I have. It's not really. My name is Caya, and I run a company called Slidebean. And what we do at this company that also makes YouTube videos, even though YouTube is not our main thing, is we help founders navigate fundraising. Because raising money sucks. We're a venture-backed company. We raised a little bit of venture capital early on. This is the second company I try to raise money for, or I raise money for, and it sucks, man. It's a shitty process, but it's as a founder or as the CEO, especially, this is probably going to be your first and main job. You're going to be out fundraising every 12 months or so, maybe every 18 months or so. Um, and for me, all across this time, and especially early stage, it was a super frustrating experience to try and raise money for Slidebean. We did, and we closed capital. And I went through those hoops, but it was painful. And probably the main reason why it was painful is because I didn't understand a lot of how the process works. I didn't understand a lot of how investors think, and I didn't understand a lot of what you should be focusing on during this fundraising process. So that's what I want to try and help you guys sort out with this session. So we're gonna have a bunch of time for questions at the end. I have about 25 minutes worth of slides. And then after that, it'll be kind of open format. So you guys can ask, and hopefully I can be useful in whatever way I can. Okay, so let's talk a little bit about funding and how that operates. The first thing that you guys have to understand about funding is that funding is really just a means to an end, right? Sometimes early stage when we when we're trying to kind of raise money to build a company, to get the business off the ground, to hire our first team and to build this product, it starts to feel like funding is the end. And again, most VC-backed companies, tech companies, are gonna have to raise money every 24 months. So I mean, and because raising money takes about 6 months any round, you'll need to be on the road fundraising every 18 months or so. And it sucks, right? But and again, that's why we start to think of it as kind of like the end game. There's so much content. We've produced so much content about pitch decks and about how to raise and about how to deal with this stuff. But it's not the end game, right? You still have to work on your product. But but the end game is, in that case, it's either selling your company or an IPO. Now there might be something missing from this chart, sorry, from this slide, which is like, well, isn't the end game of a company profit, right? Shouldn't we be focusing or figuring out how to make our business profitable? Our business is profitable, and the answer to that is not necessarily. And let me explain why. Um, Let me give you this scenario of one company. I gotta move my head somewhere. Yeah, let me give you this potential company scenario. So we want to raise a $1 million funding round. That's maybe you've done some math and you figured out that the money that you need to get this business off the ground is $1 million. Great. And so you're thinking maybe, well, I can maybe come up with a deal where I give investors something like 5% of the company, and sorry, like 15% of the company, and that'll do, right? That's what's going to get me funded. And well, let's go through a little bit of an exercise of what that would mean for an investor, right? Let's say that an investor actually gets that 15% of the company. Let's say that your company does really well, right? So you start growing and you manage to get your company to say $10 million in annual revenue, which is no small feat. Making 10 million a year is a shit ton of money for a business. Okay, great, especially if it's software, right? And margins are good. But even software companies that we can track, companies that have gone public and whatnot, EBITDA, right? Like your margins, that's your earnings before interest, taxes, depreciation, amortization, basically your net profit before taxes is about 10%. That's a pretty standard measure. I've seen 15%, 20% would be actually too good. It's really good, 20%. So let's say that you land at some conservative 10%. And then you have to pay corporate taxes on that. That's going to be about another 21% in the States. So you end up with $800,000 clean, right? So this company generated $10 million. You paid salaries for everybody, including the founders. And after all that, you get $800,000 after taxes, net income, true net income. Well, what does that mean? What does that mean for those investors? Well, 15% of that is what investors get, right? Because they own 15% of the company, right? So if you take the $800,000 and divided between all the shareholders, these investors that gave you $1 million to start this business are going to get $120,000 in return before their own taxes, right? And there is a double tax situation, at least in the States, where company pays taxes and then investors pay taxes over their dividends. So 120,000 before individual taxes. So basically, for the investors, this means that the payback period where this company will make them as investors any money is at least 9 years. 9 years to recover their $1 million, just to recover, right? We're not even talking about profit. We're not even talking about gains. This is not a great investment opportunity. It's not. They're taking in a lot of risk. They have this $1 million that are parked in this company. They depend on this company not dying, succeeding, and actually, like from the board of this company, actually deciding to pay all this money in dividends to investors, because the board of the company, which they wouldn't control with 15%, they still might choose to keep the 800K for a rainy day, and the company then keeps it and doesn't distribute it um, to the shareholders. So that's not a great deal. ROI is very unknown. When is ROI going to happen? So let's try something else. Let's do another scenario here and see if we can come up with something different. Let's say that in this case, again, company two, investors get 15% of the business. Great. But this company is not focused on generating profits. Instead, what this company is going to do is it's going to grow fast. It's going to invest this money. It's going to spend it really fast, which means that they're going to need more investors in order to do it. That means that the first batch of investors is going to get diluted too, right? They might have gotten 15% at first, but now with new investors coming in, they'll get 12, and more investors might come in. They'll get diluted even more. But because this company is focused on growing really fast, then this company might scale and grow to, say, $50 million in revenue. It's not going to make any profits, right? This is not a profitable business, but it's growing really fast. And when a company grows that fast, you have other alternatives, right? You have alternatives, for example, like a bigger company wants to buy you. They maybe want to buy you because they want to get rid of a competitor, or maybe they want to buy you because because they're looking to implement some of your technology, or because they're looking to sell. There's a good synergy between the two products. And when a company is growing and when another company wants to buy it out, right, they need to pay investors or they need to pay shareholders a good amount of money so that they're willing to kind of give away this business to somebody else, give away control, right? And it's not crazy. Actually, it's actually pretty common to see a bigger company pay something like 5x revenue, right? So something like $250 million for this business that makes 50 million in revenue, which means that 12% is going to translate into $30 million for these investors if this deal happens. So they've basically 30x'd their return, right? They've turned their $1 million into $30 million within a span of 7 years, which is what a company might take to be sold. And that is the business of venture capital, right? Again, a lot of founders I meet are thinking of venture capital as kind of revenue that may come, profits that may be paid to investors, but in reality, the only way in which which investors are able to pay back those investments is if they sell the company. So this is obviously a very, very risky path. It's very risky in part because it requires this super fast growth. It's probably not going to be a profitable business, which means that it's going to depend on multiple rounds of investors. More investors need to come in because this company doesn't make money. It's not sustainable if investors don't come in. And the end goal of this business, the only way in which this business succeeds for the investors is if it exits, right? If there's an IPO, well, an IPO is like an exit, right? You go to the public market. and people are able to trade with your stock, or larger company just privately buys you up. That's the end game for venture capital. And I've run into too many founders that are company one, right? The company one that we exposed is this company one that expects to be profitable, that expects to pay dividends, that founders that are not looking to sell their businesses because that's their child, right? I meet too many founders that have that mindset and are still going to venture capital investors to try and raise money, and that is definitely a big mismatch of expectations. Okay, so let's follow on. Let's try and understand what these rounds of funding mean, and in what stage you're in. I think that's probably the biggest mistake we made. We went out to raise money when we were not at the right stage to be in those conversations, and that translated into a lot of pain for me as founder, as I had to go and get into these conversations and get rejected by everybody that I was talking to. So that became painful. I wasted a lot of time that I could have spent um, focusing on the business, focusing on growth, making sure I got to the next stage, to the next fundable stage. And then if there's one thing that you want to understand about all this is that funding works in milestones, right? You want to focus on getting to the next fundable milestone, because that is what that is the point in time where you can start approaching investors. And if you're in the middle of two rounds, it gets really hard. So those rounds have pretty standardized names. You've probably seen them before. We call it pre-seed, seed, Series A, Series B, and the remaining of the alphabet. And so a lot of founders will think that you raise a seed round after you launch your product. Very common mistake. So you maybe bootstrap, or maybe you raise a little bit of money, you work and you grind and you finish this product, and you have it ready, right? It's ready to launch, or you launch it, or maybe you have a beta, and then that's when you go and raise seed, or try to reach investors for seed capitals. But that's a huge mistake. It's a huge mistake. Why? Because that's not seed stage. You normally raise a seed stage round when you have at least $20,000 in monthly revenue. In this day and age, or at least 2025, I'd say that standard moved a little bit. It's gotten to maybe 30, 40K in monthly revenue. That's what you need to raise what we would call a seed round. So how do you get there, right? How do you even get there? Well, if you need 30K, then you launch somewhere between pre-seed and seed, right? You don't launch right before seed. Pre-seed, this pre-seed round that you raised before, if you do, needs to be enough not just to launch the product, but to get that product to that 20K in monthly revenue. And that's the trick, right? A lot of founders get stuck halfway, and being stuck halfway, it puts you in a complicated position. You raise a Series A, for example, when you hit something like $2 million in annual run rate. Those are more or less the metrics to be able to approach Series A investors. And I have a story about this, which I'll tell you in a sec. Now, by the way, I've been talking so far about what I call a standard tech company. It's not the only type of tech company. The other type, I like to kind of summarize it into something I call R&D tech companies. So companies that do biotech, for example, companies that do again, like deep AI, when you're building this really deep, complex product that's going to require PhDs, and I think OpenAI is a bad example because of how they raised money, being a nonprofit at all. But that'd be an example, right? This is a really complex product. It's going to take years of R&D and development. It's still an unknown if it's going to happen. So that's the same for biotech that needs to go through clinical trials. Hardware companies definitely fit in this category too, R&D tech companies, because pre-seed is not enough to get a product to market, a hardware product. You need supply chains, and you need research and industrial design and prototypes and all of that. So it takes more money. So the launch for an R&D tech company doesn't happen at seed like in a usual standard tech company. But I would bet $1 that most of you guys in the Zoom webinar and in the YouTube live stream, most of you guys are standard tech companies. So let's talk a little bit about what those stages are. Like what do you need to be a standard tech company for all of these stages? So let's first go from pre-seed to seed, right? So pre-seed is probably the first money that your company might raise. And what is a pre-seed company for investors? Again, we established that launch happens between these two. So a pre-seed company needs to have a fully formed team, meaning the team that executes this product, that builds it, that markets it, that sells it, that the team that raises money, the team that runs the financials, or that runs the compliance part. All of this team needs to be fully formed by the time you approach investors. So look at what I mentioned, right? I mentioned tech skills, maybe back end, maybe front end, maybe both. I mentioned marketing or sales, one of those two. Um, I would include, operations, somebody that can just run the business, keep it compliant, not necessarily run taxes, but at least talk to the tax people in the same language. And somebody that can raise money, right? So those are 5 skills that we're looking for in a pre-seed company. So how do we go from, yeah, and it doesn't need to be 5 people, by the way, right? So it doesn't need to be 5 separate people. You have a really good engineer, a really good sales and marketing person that's also the CEO, and get away with just a duo, right? A team of 2. Team of 3 is kind of ideal. You kind of split those skills between all these people. Because remember, the CEO is going to be out of this business for many months at a time, right? If the product depends on the CEO or the founder that's doing the fundraising, and the product can move forward, if that founder is out all day talking to investors, then you're going to be in trouble because the product's going to stall when it's more critical for the product to be growing, right? So that's why 3, I think, is a really good number. But those founders need to have all the core skills. The reality with pre-seed is that you're not going to raise that much money. You're not going to raise enough money to go and steal a really good engineer from Google, right? That's not the way it works, right? You probably found that Google engineer. He's your friend, and you knew him from college, or you met at a meetup, and you got together and you want to build this. And this business is such a good opportunity. That guy is willing to quit Google to come work for this business because they really, really believe in it. That's how you form a team. And you do that regardless of the money that you've raised so far. You do that before raising money. Team comes first, money comes later, not the other way around. Um, and then another important missing factor is that at pre-seed, you need to have plans to get your first 100 customers or your first 1,000 customers. Why? Because again, you're not going to be able to hire an expert in growth. You're going to barely be able to pay your team at pre-seed, but you still, with this money that you raise, you need to be able to get to seed. And we established just a few minutes ago that a seed is a company that has revenue, maybe 30, 40K in monthly revenue. Okay. So that's what you're aiming for, right? You're getting to have a product in the market, at least 20K in revenue, growing, right? If it takes you 10 years to get to this revenue, you're not a great seed company. This must be fast, right? This must be a really, months intensive growth going from 0 to 10 to 20K in revenue. Sorry, which means that you're growing 10, maybe 15, 20% monthly. And you want to have a basic understanding of metrics, right? Why? Because as you're pitching for seed, what you're doing is, well, now we've started this fire, we've started this business, we've started this product that makes money. Now we need to grow it, right? So a lot of seed rounds are probably split generally equally between product and growth. Product still needs a lot of work, but growth is crucial, and you need to understand how that growth is working. Common deal breakers that would not allow you to raise a pre-seed. Again, you're trying to recruit the last founder. Investors don't tend to fund that. You don't have a clue on how to get customers. Investors can smell that, and you might be stuck between launch, which makes you a riskier company. Or, as you pitch it, and I've seen it in a fair share of pitch decks, you pitch the business like, oh, we're raising $1 million pre-seed to get to launch. And so, well, if you do that, you're going to be stuck in a bad position with my $1 million in, right? Because you're going to be stuck at launch, but who's going to fund that launch for you? So not a great milestone to brag about or to aim for. Okay, let's do another round. Let's do seed to Series A, right? So we established what we need for seed. We said that your first $1 million in annual run rate happens somewhere in the middle because Series A requires 2 million, right? So 2 million in annual run rate. The next requirement that you're aiming for is having a good product market fit, right? So that means low churn, that means happy customers, that means you have a really good understanding of metrics, and you understand now you've done this, you've spent maybe a couple $1 million that you raised in seed, growing this business, you understand how it works, and you understand that now the next round is going to expect you to do that so much faster, right? To deploy capital really, really aggressively. And if you don't know what those metrics are, then that becomes a red flag. And then, team ownership and delegation, I think is another important one. I've seen companies get to Series A or think they got to Series A where the founder is still doing too much of the work, right? Too much of the work depends on the founder. And that's not ideal. Okay. Um, so again, product launch, but no revenue. That would be a deal breaker for seed, right? I think the main difference, the main advantage here is you want to be in a position where investors feel FOMO, right? You want to be in a position where investors feel like if I don't invest in this business now, I will miss out on this opportunity and it's going to get a lot more expensive for me to invest later, right? I want to catch like investors, the way they're thinking is they want to catch this business just before they're discovered. And that's a great position, right? Seed is like we've validated it enough that this product works. Um, but they haven't like broken through. Whereas if you have a product in the market that launched but has no revenue, investors have all the leverage. There is no FOMO because what investors can do is they can just stall a little bit. They can just say, "Well, yeah, come back to me when you have more traction." And some of you might have heard that sentence. Just come back when you have more traction. What investors are doing is they're just stalling. They're just waiting to see what happens with this business. They're waiting to see if this business grows or not because they have time on their side and founders don't. Right. So that's why FOMO is a crucial part of this whole fundraising process. And just doing one more hoop, going from Series A to Series B, what you're aiming for, or the requirements that you need for Series B is, it's at least $5 million in annual run rate, a senior executive team that runs the business. At this point you've had enough money to hire people out of other companies, and you've hired that expertise. You're paying good money for that expertise that you weren't able to pay for before. And at Series B, you probably want to have some early traits of an exit strategy. You need to have a full laid out plan, but you need to be able to tell investors, hey, is this company going to go public, or are we looking for one of these 5 companies to buy us within the next 3 or 4 years? That's normally a requirement for Series B. Not enough revenue would be a deal. Well, I mean, would be a deal breaker. When you're trying to raise a Series A, this happened to us. Like we ran out of money before we reached Series A, so we raised the seed. We got to about 1.5 million in annual run rate, but not 2, right? And the requirement was 2. So when we went out to pitch for our Series A, investors told us it's like, well, I like what you're doing, but we invest in companies that have 2 million annual run rate or more. We don't have money to get to $2 million, 2 million annual run rate or more. We were about to run out of our seed round. And that's a rough position to be in. Whenever you hear a company that raises a post-seed round, that's exactly what happens. They run out of money before the Series A, and they've been forced to raise, usually in not the best of terms. Another common mistake I see in Series A, and I've helped companies, with a couple of pitch decks. We do that a little bit. We help companies with their pitch decks or with their narrative as they approach fundraising. Some of the companies that I talk to, they just don't understand the metrics. They maybe hired an agency and that's who led their growth, but there's no internal in-company understanding of metrics, which is a huge red flag for an investor because now you're going to go from spending 100K a month to spending 300K a month with your next round, and how are you going to deploy that efficiently? That's another problem. Okay, so that's a quick overview of funding rounds and how they work. As promised, that was what, like 20 minutes. So like I said, I have a bunch of time for questions for you guys in Zoom and for you guys on Zoom and on the YouTube live stream. Just throw them in the chat. I have them on my other screen here, try to multitask. And while you throw me some questions, I'm super happy to answer a couple of quick commercials. Now, a lot of, in this Slidebean channel, we've been covering a bunch of varied topics lately. But we have another channel called the Startup Club, which is where we do really, really deep startup dives of how to raise money or how to calculate these funding rounds or how equity works or how convertible notes work. So really deep dive videos on the stuff that you as a founder would need to know. So you should check it out. It's called the Startup Club. Just search it on YouTube. On that, we have another webinar tomorrow. I think today was 11 Eastern. I think tomorrow is going to be 11:30 Eastern, but just check what the final time is. And the idea is to kind of teach you, well, now that you've raised a round, or now that you're pitching investors to raise this round, well, how do you budget so that this doesn't happen, right? How do you budget so that you don't run out of money before the next round happens. My team's going to throw the links to the channel in the chats. So that's commercial one. Commercial two is, again, we're not just a YouTube channel. We help founders navigate fundraising. And our platform, Slidebean, has a bunch of tools that can help you with that. We have an AI pitch deck builder. We have an investor finder with over 20,000 investors that we've indexed from all over the world. We have a cap table tool where you can estimate how much you're going to be diluted depending on the round. We have a financial model tool that's going to let you estimate this, again, with some help from tomorrow's free webinar on financial modeling. And some of our subscriptions also include monthly one-on-ones. That's actual one-on-one sessions with our team. So with the accelerated plan, for example, you get a monthly session with our pitch deck team and a monthly session with our financials team and a strategy call with me. We actually do two strategy calls. We first do like a small group call to kind of understand where you are, make sure that I point you in the right direction, point you to the right resources. The next call I'm actually doing today. So if you sign up today, we'll chat later today as I got back from a little bit of a holiday break. So we can start with that. We do that small group session today, and then we do another one-on-one as you guys are getting ready to pitch investors, so we can go into some details, maybe stuff that you can't share with the group. So yeah, QR code there. My team's gonna paste the link, and I hope to see some of you. Now that's it. That's all I have. Let's jump into some questions. Let me stop this screen share and go to questions here. Okay, I gotcha. Okay, I see Jeremy Fletcher. Jeremy, maybe. Okay, what if you only need 3 customers to hit the 20K monthly revenue metric? Do you still need 100 customers, or is it the money? Isn't money the main thing? Yeah, like, sorry, I didn't clarify that better. Yeah, when you're going for seed, really what you're looking for is proof that this product works, right? Proof that that the product works, that you're able to sell it, that people are willing to buy into it. So yeah, if you're targeting B2B and each one of your customers is paying, $10,000 a month, right? Which would be a huge deal. This is almost enterprise, but I guess B2B or large B2B. Then that I would say that's enough, being able to sign 3 customers. One customer at 30K a month, I don't think is proof. 3 customers at 10K a month, I think is actual good proof that you're onto something. Obviously, this varies company to company. Whereas, the opposite end, 100 customers at $1 each is not good enough. I don't think it is. 100 customers of $1 is $300 a month. It doesn't work. Also, think of it as monthly revenue, not as annual revenue. So if Jeremy, if you're selling these deals that are annual deals that cost customers 15K, but that's not monthly recurring revenue to you, then you're still depending on going to sell 3 or 4 more of these deals next month. So I don't think that cuts it, right? It's about ideally monthly recurring revenue or monthly predictable revenue. Yeah. Okay, next one. Oh, I see one from YouTube, so I'm gonna do one from the YouTube and the Zoom. So Maso is asking, Kai, how do we prevent getting fired like Steve Jobs from our own companies? It seems like the only way is to bootstrap so that we don't hire our own bosses. Could you elaborate on this? That's actually a good question. That's a really good question. Getting CEOs or founders getting fired from their own companies is like this Hollywood, a very Hollywood horror story of a founder leaving. Normally, when a founder when a founder slash CEO leaves the company, it's either because they're looking to do something else, doing the same thing for. And I think a defect of entrepreneurs is that we don't like doing the same thing for too long, right? And if you've been working for a company for 10 years, maybe you want to leave. Maybe it's not that, maybe you don't want to do this anymore. That happens, right? So it's not always, all these horror stories. I think it's only a small percentage of a founder getting fired. The reality of this is that you're going to lose board control of the company soon. There's this Carta launched this nice report last year on the fact that by Series A, all founders together normally no longer own 50% of the company, right? So after 3 rounds of funding, pre-seed, seed, and Series A, the equity that will be issued to these to these investors in 3 rounds of funding will be more than 50%. So the founders altogether, right, assuming that they're two, maybe they'll own 40% of the company, 20 each. So at that point, if your founder and the investors agree that you're not doing a great job, you can get fired. There's at that point, your job is less important than the financial benefit of the company, right? So it happens in really, really extreme occasions. I see a lot of founders very worried about kind of getting fired from their own companies. But again, the reality is that you usually a single person is not good enough to make big decisions in a company. Normally, that's what the board is for. The board is a group of people that you trust. And if 4 of these people agree, if 4 out of 5 people agree that something should be done one way and not the other, I would normally trust that call more than the single guy, even though that guy is the CEO. So sometimes I think that the whole process of starting a company or running a company, a lot of that has this factor of, hey, maybe I'm not right. And I'm often wrong. And it's important to have people that you trust to point you that you're wrong about something. Okay. Yeah, sorry. One last thought on that is like if I as an investor, I'm invited to invest in a company that where the founder has sole control of the business and nobody can question them, or that they have the final say on everything. I probably wouldn't want to invest in that company. I think that becomes a bit of a flag. Just one person, right? Because at some point, you'll need people with more experience. And if the founder made a big effort or a big deal out of not losing that control, I think that becomes a bit of a flag. Okay. Barry, when you are in early stages, when you're in early stages, when you're in early stages, talk about the notion of running out of money. If that's driven by the team salaries, pay cuts could resolve a lot of burn and bridge to higher revenue levels, right? What's been your experience in those sorts of situations? That's a good question. That is a good question. Yeah, I mean, I think that we have to start with the premise that everybody needs a salary, right? You can't have people working for free. Um, and so, salaries is by all means the biggest cost in a company. Um, Founder salaries obviously come first. I mean, not come first. That's the first expense, and then team salaries. Usually that team will make more money than the founders at the early stage. Why? Because the founders have an incentive, which is the equity, and that they own the business, and the team, probably they'll own a little bit of equity, but their main incentive will be salaries, right? Founders are risk takers. They're the ones that started the company, so they were willing to take this extra risk. Now, yeah, like if your company runs out of money, it's usually you because of salaries, because that's the biggest expense that will be your biggest expense for years. And what does that mean? Well, it means that nobody else can work in growing or selling this product, and you probably have something like a dead company, right? If nobody is working for it or selling it. And I've seen many of my friends, close friends, fail. And it sucks. If I had one piece of advice for this on this, it's like, yeah, most startups fail. Like, statistically, most startups fail. Um, I think that I've seen founders kind of stretch that as much as they can. I have a good friend that recently has a family. He's older than me. He has a family and rent and whatnot, and he recently took like this massive pay cut in his salary, which was a standard salary. And he took this huge pay cut just to try and keep the company alive a little longer, or try to close this round, because it's close. They're really close to securing the next round of funding, which would allow them to continue working on this. So he like took this risk and said, well, okay, I think that if I can survive on this shit salary for 2, 3 months, and because I believe there's this light at the end of the tunnel, which is this next round that they're raising. I've seen founders do that, and sometimes it works and sometimes it doesn't. Yeah. So, and I think that founders are should be the first pay cuts. Cutting the salaries of your team is really, really dangerous. You lose a lot of trust from your team. People who work for a startup, people who start a startup, they're prepared for the companies they're prepared to go out of business and have to find a job. People who you gave a job to, right? People who were hired as an employee, they're not as ready to be out of a job, right? Or like suddenly to have their salary slashed. That may be illegal even depending on where you live. So yeah, you always probably want to start with the founders, with the salary cuts, and then if your team is in agreement, maybe the team, but that's only it has to be a temporary measure, and it has to be on the assumption that something will happen to solve that, either um, either a next round of funding, or just a massive deal that's about to close, or a big spike in revenue happening soon. And you should always be very transparent when you have to resort to that option. Okay, next one from people on YouTube. You probably have this 20-second delay on where I am. So again, if you want to throw a question, make sure it's there. Yeah, I'll take another one from Zoom. So Ahmed is saying, I'm from South Asia. Any suggestions/advice on raising pre-seed for fashion tech marketplace startups? My supply side is growing and launching next week. I'm burning cash on tech side due to some heavy innovations that are currently missing in the market. Any advice? My biggest advice on fundraising is you always have to chase capital where you're based. I would, or where the not where you're. Yeah, so you want to chase capital where either the founders are based or where the customers are based. And really that's the same answer, because you ought to be where your customers are. Right. So, it's really weird for a US investor to invest in this South Asia startup fashion tech company. Why? Because they don't understand the market. They don't understand the supply side that you've built so far, because it's very foreign to them. And I see a lot of founders kind of like were asking me, it's like, hey, how do I raise money in the States? I'm like, well, no, you shouldn't try to raise money in the States if your customers aren't in the States. You should raise money where your customers are, which by extension is where you should be. Also, a lot of funding rounds, a lot of VC money, like it works out of reputation or network, right? The first people that you chase for capital are people that you know, people that you're already connected to, people who can vouch for you, not because of your product, but because they believe in you, they've worked with you before, they trust you. And that's, I think, what makes um what makes it gives you the chance to raise money early. Going to complete strangers for capital sends some bad signals. For example, it basically says, oh, I don't know enough people to fund this business, which by extension kind of means that you're maybe not that well connected, which is a risk for your company, because you're going to have to raise money again and again a lot of times. Yeah, hopefully that answers your question, Ahmed. Let me know if there's any. Maybe on the self-funded part, what I'll say is, we all have to pitch in, right? We all have to put in money of our own, either because we are not making a salary. This is live, GoPal 7338. We either have to sorry, lost my train of thought, man. After that, oh, on self-funded, right? So we always have to self-fund something about our companies, right? It's either not taking a salary, or funding the first servers or the first laptop purchases, or maybe some team salaries early on. I went into with my first company. I ended up going into debt. Like, I actually used my credit card to pay for a lot of stuff that the company had to pay for, even my own expenses. I just spent on credit cards, and I thought that was the biggest mistake. And luckily it wasn't too bad, but it could have been a lot worse. So I would never go into debt to fund a business, and I would never use the entirety of my net worth to fund a business. That's what investors are for, in a way, right? It's people who you're sharing the risk with, and that's fine. And that's fine. I'd be maybe willing to, if I really believe in a company, I'm willing to spend some of my savings or some of my money into this business, but not all of it. Why? Because I'm biased, right? I'm skewed. This is my idea, and I'm always going to be biased towards thinking that it's going to be better, when in reality it's just your own idea. And you want to share that load, and you want somebody else to kind of validate that this thing that you've come up with is actually a business with potential, rather than just a pipe dream. It's like, I'm a big movie fan. It's like Francis Ford Coppola with Megalopolis, right? This apparently terrible movie that nobody wanted to fund, so he spent his life savings to fund it, and it tanked. So you want to share that risk. Okay. Any other questions, guys? We still have I still have a good 20 minutes left, but if you don't have anything else, which looks like you don't, we'll maybe call it a day. Again, make sure to check out Slidebean Accelerator. We've dropped links in both chats. One-on-one sessions with our team to talk about your pitch deck, to talk about your financial modeling, to talk about your budgeting. Don't forget to tune into tomorrow's financial modeling session, where we'll go in depth about how to make sure that you don't run out of money. Oh, Ahmed threw one just in time. Last question. Would you invest in any company as you have the experience? Yeah, I would invest in companies. I think I might get a job at a VC firm at some point. I think I have a decent eye. I've seen far too many companies, and I don't have enough money to invest in companies yet, but I absolutely would. Especially if I'm investing somebody else's money. That's what you do at a VC firm. Okay. If you had to bootstrap in 2026 with a B2C app that is like LinkedIn, how would you win with AI or without AI? I don't think that the question this year is without AI. I don't think that anything exists without AI. Regardless of how you feel about AI and dominating the world, I think every company has had to like implement some form of AI, and some AI implementations are actually pretty good and pretty useful, right? It's not just doing it because of the hype; it's because there are useful things that you can do with AI. So I don't think that that's the question, Masso, if it's with or without AI. Again, back to the bootstrapping question. I think as long as it doesn't endanger your own personal finances, then bootstrapping is fine. If it is, and again, make sure that when you're going into bootstrapping, right? Remember what we said with the slides and the this jump from pre-seed to seed, right? If you're choosing to go this bootstrapping path, make sure that you have an oxygen tank to survive until the next funding round, right? If you try to bootstrap between pre-seed and seed, and you're not out of money just before you launch the product because you didn't have money for marketing or growth, then you are stuck, right? You are stuck in this bad position where nobody's going to fund your startup then because it's a bad position to be in, right? So I would rather, if I only have money to bootstrap through launch or through finishing the product, I would rather not bootstrap at all. I would rather wait until I can raise some money and make sure that I have enough to launch it, because otherwise I'll bootstrap, I'll be spending my money, and then I'll be in the same place, in a position where I'll be in a worse place, right? I'll be in a moment between rounds where it's hard to close any capital. Gopal, with all the learnings and experiences that you've had, if you start now, a startup, what would you prefer, bootstrapping or funding? Yeah, back to the same question. I would only bootstrap if I know, I would not start a company by myself first. I would probably find a co-founder that is, and see what their situation is. If both of us can bootstrap and skip the pre-seed round, right? Skip the pre-seed round altogether. Get to seed, meaning make sure that we have revenue, have that 40K in revenue plus 6 months of runway, right? If we have enough money to do that without endangering our finances, then I'll bootstrap. If I don't have that, if I don't have enough money to do that, I wouldn't. I'd raise money. I think that the fastest growing companies raise money. I think it's an illusion to think that we can build, true unicorns with yeah, not even unicorns. Unicorns that's a can you build $100 million company bootstrapping? It's really tough. It's really tough. There are like a handful of stories of that success. Most companies achieve that faster with less risk to the founders by raising money from investors. I've had good experiences with investors, to be honest. And the founders that in my immediate network have honestly also had good experiences with investors, where this evil investor that takes away your company is not something that I think I haven't experienced, or my closest founder friends haven't experienced either. Um, yeah, kind of to your point, like considering bootstrapping would take, say, 5 years. 5 years is a lifetime, man. As a founder, it's a lifetime. The world, think about it, literally think about AI today, right? Like we tried to start like this spin-off product from Slidebean back in 20, I think it was 2021. We kind of set aside this little team to build this side product. That was like this SaaS subscription tracker thing. And in the span of a year or a year and a half, five different companies with that exact same idea launched. I'm not saying they copied us. We all came up with the same idea at the same time, except that all these companies were venture backed, so they outran us really quickly. Problem number one. And then problem number two, we built this really complex algorithm to process invoices and to process expenses and to be able to track them in this thing. And then, 12 months later, ChatGPT launched, and that, ChatGPT, a good API call could have solved all of this thing that we built. So the world transformed itself in 12, 18 months, which rendered our product useless, right? So if you're bootstrapping for 5 years, look, imagine what would happen, what could happen to kind of completely transform the landscape, right? So I think in tech, especially in tech, 5 years is a lifetime. Oh, also for you as a founder, honestly. It's a lot of time, a year. Imagine all the experience that you could get if you, I don't know, if you got a job at another startup for 3 years and then quit. I mean, got a job at another startup for 3 years, get all that experience and know how to, learn how to run a business from an actual successful company and then quit and do that. Like I'd rather spend my 5 years doing that than just bootstrapping really slowly and spending my own money. Yeah. Okay. I think that's those are all the questions. So again, thanks a lot for tuning in, guys. Remember tomorrow's webinar. Remember Slidebean Accelerated. We have a kickoff session later today. We get a chance to do one-on-one if you have any follow-up questions in a much smaller group. Have a good one. Bye.